What if I told you you could make money whether a stock goes up, down, or goes absolutely nowhere? Sounds impossible? It's not. In today's video, our head of options trading breaks down a win-win-win strategy that top traders use to stack the odds in their favor, no matter what the market throws at them. I'm Mike Bellafiore, co-founder of one of the top proprietary trading firms based in New York City since 2005 and now in Miami. We've built and backed some of the best traders in the game. Stick around. This one could change the way you trade options forever.
Hi, I'm Seth Freudberg. I'm the head trader of SMB Capital's options trading desk here in Manhattan. And we're in contact with traders from all over the world, many of whom have heard that there are option strategies that have extremely high win rates, probabilities of 90% or more of a particular trade winning. And that, in fact, is statistically true. There are such strategies, very low return strategies, mind you, with a lot of risk in them. But there are, in fact, some strategies that have an excess of a 90% probability of being profitable if you stick with it until the end of the trade. And with that being true, it's natural to ask if there are strategies that actually have a 100% win rate, and that's what today's video is about. So if you're curious about the answer to that question, then stick around because I think you're going to find this interesting. Now, before we get into the strategy that I'm going to be covering in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we've put together a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategy that we'll be sharing with you in this video. Then, when you're finished, you can come back and watch the rest of this video. There's been a lot of talk about the bond market these days, rumblings that something's going on in that market that's pointing to larger concerns about the world economy. And in fact, longer-term bonds, including long-term U.S. Treasury bonds, have in fact been weak since the pandemic, with interest rates steadily rising on those bonds over the past 5 years, as you can see from this price chart of the 20-year Treasury yields. And as most people know, when bond yields go up, the prices of bonds go down, and the stock that most closely tracks these long-term bond price movements is the ETF known as the iShares 20-plus year Treasury Bond ETF, which trades under the ticker symbol TLT. And so we're going to go all the way back to the beginning of the millennium. And as you can see, TLT over that last 25 years has never traded lower than a price of 80, not even once, although it did briefly drop below 81 in 2004, more than 20 years ago, as you can see from this 25-year chart of TLT. And so now let's zero in on that year, 2023, for the TLT. And as you can see, the stock has been dropping substantially all year, down from over 100, inverse to what long-term interest rates were doing that year. And in fact, on October 3rd of that year, TLT had dropped to its low of the year, closing at 85.06. And you'll notice that the RSI indicator had actually pushed down to almost 20, which is a massively oversold number that day, and is the kind of reading that attracts interest among traders because it's often seen as a bullish signal pointing to an extremely oversold stock that may be ready to bounce. And so let's say that on that day you had opened up an options chain of TLT that expired at the very end of the year on December 29th. The final trading day of 2023, and you looked for a put option that is located at a strike price that is lower than TLT has ever traded, which is that 80 strike price. And you sold 10 of those for $1.59, and at the same time you bought 10 of the 70 puts, 10 points lower for protection. Well, when you do that, selling a put higher up on an options chain and buying a put lower down on that same options chain, when you do that, you are selling what is known as a put credit spread, which is a bullish option strategy, and you'll see why that's true shortly. And so to understand how we're constructing this trade, let's first look at the cash flow of the put credit spread, because that's going to be important to understand what we're doing here. And so starting with the puts that we sold, those 10 puts at the 80 strike price, well, we sold those for $1.59. But remember, put options represent the right to sell 100 shares of a stock at the strike price. And so you multiply that by 100, and we sold 10 of them. And so when you multiply it all out, you end up with $1,590 in cash. And you have to deduct from that the $300 you paid for the 70 strike price puts, resulting in net positive cash flow of $1,290, for which your broker will require you to have at least 8710 in capital to execute in the first place. But we're not done yet, though, because we're going to add something to this trade, something that can supercharge the results of the trade, making it even more bullish. And we're going to accomplish that by simultaneously buying 10 of the 93 calls, a strike price about 8 points above where the stock is trading now for a price of $1.01. And it was not an accident that we bought those particular call options, because as you can see, when we subtract the cost of those 10 calls, which was $1,010 from the original cash flow we received from the put credit spread, we are still left with a positive number, $280. And because we bought those calls, your broker is going to add to your capital requirement the cost of those calls, bringing your total capital requirement now to $9,720. And so, to review the bidding here, we put on a bullish put credit spread and added to it a bullish position in the form of a 10-lot call position up at 93. And after we execute this trade, we are still positive cash flow in the amount of $280. And so one of the reasons we chose those 93 calls was the fact that while they ate up most of our cash flow, we still had positive cash flow at the end of the day, and you'll understand shortly why that's so important. And so now that we've added those calls to the trade, this new combination is a modified version of the option strategy known as the risk reversal, which is a very bullish position that options traders like to enter when they think that a stock has become oversold. Okay, so now let's move to the end of the year. And as you can see, the stock did indeed bounce, closing at 98.88 on the day this options trade expired. And so at the end of the day, as you can see, the 93 calls are trading at 592, which makes sense, right? Because if we exercise that call, we could buy 1,000 TLT shares at 93, even though the stock's trading $5.88 higher, up at 98.88. So it makes sense that the stock is trading at 592, because if you think about it, the value of the 93 call is the difference between what you have the right to buy them for and how much they're actually trading for. And so it makes sense that the call option is trading for almost exactly that exact difference. And of course, the puts are both trading with no value because they're located at the 80 and 70 strike prices, and therefore will have no value at expiration because there's no value to a put that gives someone the right to sell their shares way below where they're trading in the open market. So those puts simply expire worthless. And so when we look at the results of the trade, starting with that $280 that was our positive cash flow after we bought the calls, cashing in those 93 calls would result in $5,920 in value. And of course, those two puts go out worthless, resulting in a final profit of $6,210, a return of more than 63% in less than 3 months. Now, before we wrap up, I did want to point out something very important about this trade, and that is that if you think about it, there were really 3 possible outcomes for this trade. The first outcome is the one that we just shared with you. And of course, that's the best outcome, where both the puts expire worthless while the call can be cashed in for some value. And that, of course, only happens if the stock closes above 93 at expiration, as it did in this example. But have you thought about the second outcome? Suppose the stock closes between 80 and 93. Well, in that case, the call expires worthless because the closing price is not higher than 93, which would give the call some value, nor is the price below 80, which would give the 80 and 70 puts value. And so all 3 options expire worthless, and your profit is the $280 in this case, the amount you collected in the beginning. And finally, the third outcome is that TLT somehow closes below 80, which it has not done in this entire millennium. But in that case, you'd be assigned the shares of TLT because as a put seller, you're obligated to buy those shares at $80 per share. But think about it. You now own shares of a stock that represents the 20-year U.S. Treasury notes at the lowest price that it's been trading the entire millennium. It's hard to see how that is not going to be a win eventually, if not immediately. And so because of that, all three scenarios are considered a win, which is why this is known as the win-win-win trade to professional options traders. And so what I'd like you to take away from today's video is that while there is, of course, no reward in life without risk, there are options trades where literally every possible outcome is positive. In some cases, your reward may not be immediate, but is almost always, with a little bit of wisdom and patience, rewarding in the bigger picture, like the scenario of owning the TLT shares at their lowest price of 25 years, as contrasted with the first two outcomes where you enjoy immediate profits. These kinds of trades are available to trained professional options traders, and there's no reason that retail investors like yourself can't benefit from these powerful option strategies as well.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.